The achievement of low and stable inflation in the mid-1980s has led to a significant change in inflation dynamics. Most striking is a major drop in generalized price changes across a broad range of sectors in the economy. Put differently, most of the fluctuations in headline consumer price indices are due to price swings in very specific goods and services. At the same time, changes in the stance of monetary policy affect a remarkably narrow set of prices, most of which are in the service sector. Our evidence also suggests that the so-called second-round effects, or the indirect effects on inflation through increases in longer-term inflation expectations and wage pressures as a consequence of higher prices in specific sectors, have become much more muted since the mid-1980s. As a result, overly forceful monetary policy actions may be required to nudge inflation towards targets. Such an environment thus limits the ability of policy to steer inflation within narrow ranges. This puts a premium on flexibility in pursuing inflation targets, both in terms of tolerance of deviations of inflation from targets within certain ranges, and of longer timeframes to bring inflation back within those ranges. Such flexibility can be especially important when inflation is hovering persistently below target, calling for a monetary easing. So just like a credible conductor of a well-rehearsed symphony orchestra can afford to lead her musicians with minimal gestures, so a credible central bank can afford to let inflation evolve within a wider range of its target without energetic adjustments to the policy stance.